Hey everybody, it's Jennifer Antiel here with the DIY Academy, and I have another training hot and ready for you today at 11:30. Reminder, we just go live here for free every day at 11:30 talking about all things business, um, random things that I pick off the top of my head, basically. So let's get started. Today, I just wanted to give you 3 things that I really see a lot of business owners doing in their accounting and their bookkeeping that they're doing wrong. And so just to bring those things maybe to light, shed some light, and hopefully get people to stop doing this. So the first one I see a lot is people booking a credit card payment as an expense. This is not right. So like what you need to be doing is say you have a credit card and you go somewhere during the month. Let's say you make like 5 purchases, right? With that credit card. What you need to be doing is booking each of those expenses or those transactions of the things that you purchased. Like say you went to Home Depot and got supplies, and then you went to Lowe's and got supplies, and then you went to Target and you got office supplies. You are going to be booking those individual transactions to your in your accounting software or as an expense, not taking. Oh, and then like at the end of the month, you pay your bill. So say your bill was like $500, so you pay $500. You don't book that $500 credit card payment in your accounting software because you've already booked the individual transactions to each of the places that you spent the money at, right? So I see a lot of business owners booking their expenses. So like they would have their Target expense, they would have their Lowe's expense, they would have their Home Depot expense, and then when they turn around to pay their credit card, they also book that expense. That's not how that works. So stop doing that. If you're doing that, what you're actually doing is you're overstating your expenses for that period or the year for when you do your taxes. So that is not what you need to be doing. So stop doing that. The second thing I see, this is more for businesses who have a vehicle in the business name, because if your vehicle is not in your business name, this wouldn't apply to you. Like you wouldn't be having a car payment, right? So if you have a car in the business name and you have a loan on it, for example, so you're paying a monthly payment on it, I see a lot of business owners booking the entire payment as expense. So like a vehicle expense. A lot of people say like vehicle loan expense. That's not right. What you should be doing is every month, if you've ever looked at it at your like loan statement, they should have your payment broken down. Say your payment's $500 a month, 300 of that is going to principal and maybe 200 of that is going to interest, just pulling random numbers out, right? So what you should be doing is only booking the $200 interest as an expense. Interest is essentially the only thing that you can expense, because on the flip side of that, the $300 principal payment, that is going to be reducing the loan that you have sitting on your balance sheet, which the balance sheet is not your expenses, right? The balance sheet is what you owe, what you own, and then your equity. So again, what you owe. So any liabilities, meaning credit cards, loans, any like payroll tax liabilities, anything like that, what you own. So these are your assets in your business. So yeah, if you have an auto loan, that would be considered a liability because it's a loan. You have to pay it back, right? So that would be on your balance sheet. And so every time you make that $300 principal payment a month, it's going to be reducing the liability on your balance sheet. So that $300 technically is not a business expense to you. So when you have a loan on a vehicle that is in the business name, the only portion of your vehicle payment that you should be expensing or taking an expense on is the interest. So stop booking the entire loan payment to a vehicle loan expense, people. Not how it works. Third thing I see people do wrong, and I don't blame them. Sales tax is really convoluted and confusing and messy, especially with all of the changes that recently happened. But I see a lot of people not charging the right sales tax. Things are very all sorts of things happen. But the biggest two that I think I see are charging customers sales tax based on like where your business is located at. This may or may not be correct. And so it's not correct. It is correct to charge them your business, like where your business is. It's correct to charge that rate if your customer is like picking up the goods or, you know, something at your place of business. Like you have a retail store, right? Wherever your retail store is, that's what you want to charge. If you're sending something out or delivering it to your customer, you need to be charging sales tax based on your customer's address or like where it was actually delivered. Where it might be different, where you're not charging like to your customer's address, is say you are a wedding florist, right? So you're selling the flowers, packaging them up, selling them, and your customer lives in a different city than where your business is, right? And the wedding venue to where you're delivering the flowers to is in a different state with a different city with a different rate. You don't charge the sales tax based on where your customer lives. It's my camera. Customer lives. You actually charge it where you're delivering the flowers to the wedding venue. See how it gets a little tricky and convoluted? So it's not shocking to me that I see these things, but these are very typical things that I see. The other thing related to sales tax that I see a lot of people doing is charging clients that you don't need to charge sales tax on. I've talked to several business owners recently, and they have a business here in our state of Minnesota, and they have customers that they actually ship to in different states. And they are charging their customer like Minnesota state sales tax. And that's not right. Shouldn't say more than likely, but the only reason you would charge an out-of-state person sales tax, but you have to charge it based on their address. So like if they're in a different state, say they're in Wisconsin and you're selling it to Wisconsin, you would charge Wisconsin sales tax. And the only reason you would need to do that is if you have nexus in that state, and there's certain requirements that need to be met to make that nexus. And so like a lot of times it's number of sales or amount of sales that you transact in a period, based on like basically based on how much business you do in that state. If you don't do enough business to have nexus, then you don't technically have to charge them sales tax. But if you do meet their requirements, say their requirements is you have to sell $10,000 worth of goods to customers in that state, then you would meet nexus and you would have to charge any Wisconsin customers of yours sales tax. And for you to do that, you would actually have to go and register with that state to get a state tax ID. And it's crazy and complicated. So that was all I wanted to cover today. And in case you didn't realize, we have the August Hustle Bootcamp starting tonight. We're going to be live right at 8:00 p.m. And I think we're going to do it on, I haven't decided if I'm going to do it on, what I'm going to do it on yet. It's probably going to be on reflection of your business. And we're going to talking about looking over your last year of business and see what worked, what didn't, and how to use what you find to really like launch your business into 2020 and make it a better year. So that's it for today. We will see you tomorrow at 11:30, and bye everybody.